Whilst we're new to Pinnacle, we've been around for a long time. So our strategy was first seeded about 8 years ago by a multifamily office in Melbourne. And the reason they did that was very, very true today and still applicable. So what were they looking to do? They were looking to increase income, especially relative to traditional deposits and bonds. They were looking to diversify their holdings, like many family offices, very, very long property assets for their income. And they were looking to maintain liquidity. They feel and we feel that liquidity is one of the least understood and least valued functions of investment, and it's particularly undervalued when markets are bullish. It's always easier to buy and sell when things are going up. It's harder when things are going down. Over the next 15 minutes, we'll talk about the following three things, and ask three questions. Firstly, how defensive and diversified is your portfolio? Is it doing what it's meant to do for your investors? Provide our solution. We think we can add real value as a third pillar to your defensive offering, and then walk you through our approach. So, this chart is controversial amongst some people, but Australians have gotten really, really wealthy, particularly over the last 30 years, by being very, very long equity exposure. It's worked, it's been terrific, but we're, as a country, incredibly underweight defensives. There's a lot of room. For your investors and for your clients, as they get older, as they're more worried about income, as they're worried about equity market valuations, they're worried about volatility, fixed income, whether it be private credit, global bonds, global credit, offers a really, really attractive solution. When we dig deeper, the really interesting thing about Aussie asset allocation is we love what we know. So, we're very, very long Australian assets. We're very, very long property and financials. In fact, we're over our skis. Once again, fine, it's great to own things but in our minds, diversity is one of the easiest wins in investing, and we're not doing enough of it in most portfolios. So what's our solution? Our solution is global credit, but differentiated to what you will often see, which is investment grade, $30 trillion of safe but low yielding securities. We focus on sub-investment grade markets, so particularly US and European high yield bonds and leveraged loans, the liquid parts of structured credit markets, so asset backed, which trade, and bank and insurance capital, particularly globally. Now, the common characteristics of all those markets are really important. What are they? Contractual coupons. So, the companies have to pay us our quarterly and semi-annual coupons. Hard maturities, liquidity, and finally security. So, on average, when you look at our markets, what are you actually getting? You're investing in the debt of the largest global issuers, and you're doing that at about a 40% LTV to public market valuations, and you're investing it in brands that you would know. So about a third of our markets are publicly listed S&P 500 companies. The rest are the largest issuers out of private equity. So the debt issuers that are too big to go to the US private credit market or the private credit markets anywhere issue debt in our markets. And they're brands that you'll be really familiar with, right? So Samsonite, Hilton, Bayer, Goodyear. There's a sample. There's, domestically companies like Myob, Arnott's, Flora Foods. So it's not so unfamiliar to you. In fact, if you were to look at your, international equity holdings and look at a global credit portfolio, there's a lot of overlap. What's really perverse right now, and Chris alluded to it in his speech, is there's an enormous divergence between fixed income valuations and equity valuations. So the equity risk premium today is the lowest it's been in a generation. Look, that may work and continue to work, but you really do need to believe in a lot of growth and multiple expansion. Whereas for our funds, what do we need to believe? We need to believe that the issuers in the portfolio are going to pay their coupons and they're going to repay us. there's really a lot more certainty in what we do. And in today's environment, we're actually getting paid more than we ever have in the past, especially relative to equities. Now, these aren't new markets, and there's a ton of data that talks about the risk-return characteristics. And if you read the press, you'll often hear, high yield, high risk, but there's not a lot of analytical robustness about what those yields deliver for you. But the data is there. So when you invest in global credit and when you invest in sub-investment grade credit, over the last 20 years and longer, you've achieved exceptional return for your risk. Your risk-adjusted returns are great. You've achieved double the return of investment grade with the same volatility. You've returned somewhere between 2/3 and 3/4 the return of equity markets with 1/4 of the volatility. So from a portfolio construction basis, it just works. And if you're under-allocated, you need income and you need liquidity, it's an excellent solution. So as alluded to, we think that our strategy and global credit in general is just a third pillar to your defensive allocation, and it really helps you optimize that trade-off between returns and liquidity. As alluded to, we do think that liquidity is undervalued in investment, and we hear a lot of talk about liquidity premia for private credit managers, and there is a liquidity premia. The question is, how do you actually measure it? It's because you don't have the transparency to know to measure apples to apples, and it's very easy for a private credit manager to take more credit risk and call it a premium, right? Whereas in liquid markets, there are thousands of investors who trade on a price every day. We may not always like the price, but there is plenty of counterbalance for assets. Now, a little talking about our approach. We are ultimately bottom-up fundamental investors in credit. We believe that credit, regardless of whether it's private, global, investment grade, sub-investment grade, is an underwriting game. You get paid to earn your coupons, get repaid, and have security. And you can do that, and if you do that consistently, you can have excellent outcomes. Every security we have in our portfolios needs to follow these three core pillars. So they need to be mispriced, and mispricing happens in credit markets all the time. They are inefficient. I'll touch a little bit more on that in the next slide. There needs to be a margin of safety, and we're really fortunate in credit in that there's multiple levers for margin of safety. There's credit quality. There's the ability to de-lever from cash flows. There's collateral. There's documents, there's covenants. And those features are prevalent through everything in the market, and our job is to carefully assess value. And finally, catalyst, right? I think if you're an equity investor, you can think an asset's cheap for a very long time before the market agrees with you. Whereas in credit, there's a catalyst for everything we own, which is maturity, and also there's usually multiple catalysts. The documents which we work in are structured to have callability or repayment features that reward early repayment. So there's a lot of optionality where you can earn really attractive defensive income with a little bit of upside. So let's talk a little bit about why credit markets remain efficient before delving into what we do in a bit more detail. Credit markets, they trade over the counter. You need to have the relationships and the institutional infrastructure to actually access these markets. It's very hard to do yourself, and it's very hard to do yourself, even if you can, to not know that you're getting ripped off, right? Because everyone's there and they're really opaque. We've been around for a long time. We have institutional quality infrastructure that allows us to access these markets and access these very real things in liquid markets. What we've seen over my career is that credit markets have become incredibly passive and also macro-driven. So people have forgotten about underwriting, and they talk about credit spread compression, they talk about what the Fed's going to do. It's all very exciting, but the reality is, what do we care about? Whether we're going to receive our coupons and get repaid. I want to talk to you through like a real world example of what we do, just to give you some context, right? So, ultimately, we're bottom-up investors, and we're looking for mispriced assets. You may not know this business, as I suspect 99% of you won't, but you know what it does. It's the largest Taco Bell franchisee in the US. 350 stores. They generate about a little over $2 million per store. They have a 20% margin, and 80% of that drops to cash. Now, we've been following the space at every level for years. In December 22, when markets dislocated, volatility is an opportunity. And the loans in this business, this is the mezzanine loans, traded from par to low 90 cents in the dollars of no fundamental news of the company itself in about a month. Now, if you see an opportunity for something like this, where this business has incredibly stable cash flows and revenue that's been growing at mid to single digits for a decade, and you see a security that is about 40% loan to value to publicly listed comps. So for context, when these things were trading at 92 cents and offering a 16% yield to maturity, Restaurant Brands, which many of you will know, was trading at a 16 times multiple, right? So with an enormous equity cushion on anything that's comparable. It's a really attractive opportunity for those, if you've done the work and you follow things closely. So we purchased this at 92 cents. I would have liked to own it for longer, but the market realized that this asset was cheap, and they actually refinanced the whole capital structure. The really interesting thing about the refinancing was that they refinanced the whole first lien and our second lien position together for the same leverage. So it kind of tells you that if you're active and do the work, there's plenty of opportunities. So, how have we done? We had a really, really strong year over the last year, delivering 11.6%. The more important thing is, since the nearly 8 years inception, we've done exactly what we said we would do. So we've delivered, more than cash plus 4. We've done that through, multiple, a reasonably long period of time, where we've had, COVID, a bond market blow up. But by being a credit selector, by being super active and constructing well-diversified portfolios, you can achieve really, really attractive outcomes. So, key takeaways from this session today for all of you, investing with us allows you to access a really large and liquid asset class, which is, really underallocated in most portfolios. Our allocation is complementary and additive to what you're already doing in your defensives, allowing you to increase yield and income while remaining defensive. And we've done an excellent job over a long period of time. The portfolio remains attractive at 9%. There's no problems with scalability given our opportunity set. And we expect to just continue to do what we do for a long time in the future.